And then we are going to have a construction teammate on the show
Love
for
that.
next Tuesday.
Is it Tom?
I hope so. Waiting to hear back.
Okay.
Yeah.
Okay. We're good to go.
Okay.
Sure. The mute is here. We ready, bro?
We ready, baby?
It's late. Oof.
Do it.
Oh, welcome, everybody, to the weekly edition of the Not Your Average Investor Show. Today, we are going over the latest ULI Emerging Real Estate Trends Report. We've got 5+1 bonus takeaway that old GC and I have poured through this report. We're going to bring to you. We're going to share that report shortly. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because it's Genius Concepts, knows how to generate cash flow, is a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
It is great to be in studio today and in 2 weeks. Breaking news before we even do the roll call. What's going on in 2 weeks, GC?
We got the Q2 2026 Real Estate Market Outlook. It is the quarterly event that we put all of our heart and soul into, and I've been in the lab preparing for it already, guys. So it is 2 weeks from today, March 24th. Go ahead and save the date. If you are here live on the show in the audience right now, you don't have to change anything. You just show up. It's the same link. If you are listening in podcast land, then you will want to go to NYAIS.com and register so that you can get the link and you can show up in the live audience. But you're going to want to be there. We're going to go over things like seasonality. We're going to take a look at what's going on in the greater real estate world and some of the headlines that are happening. We're gonna kind of dissect a couple of them and separate the noise from the reality. We're gonna take a look at mortgage applications as well. We're gonna talk about what's happening due to lower interest rates and how this can set you up to make really great decisions. And there's 2 or 3 other things that I'm thinking about including in there. So it's gonna be a meaty one, and you are going to want to be there March 24th. 12:30 Eastern.
March
You know the drill.
24th. Be there. It's the big daddy of them all. I can just tell by how much the volume of your voice went up when you were talking, how excited you are. I know that you just delivered the first draft of the team today.
I did.
Got some feedback.
Yeah.
We're going to do some more. We go through this. It's like a 3-week prep to bring you the show. So you want to be there. It's thebomb.com. And speaking of that, I don't know how to transition here, but we have a little tradition that we normally start the show.
It's the roll call, baby.
The MVP is off the
Mr. Lee Bishop. Lee Bishop, just so you know, that blanket, that summit blanket is coming to you. You've been waiting for like 2 years. I got it shipped for you, so it's coming your way, buddy.
Yo, Blanky. Jimmy James in the house from New York.
All right, all right.
Jaime Pedraza.
There we go. Jimmy James. There we go. No, Jaime Pedraza. I didn't see Jimmy James. There we go. Good to see you.
I like how you say it. We got our leadoff hitter batting third today.
John Henny.
We got Mark Norman from SoCal.
All right, Mark.
Good to see you, Mark. Who else we got in here? We got Joanna in the house. Good to see you, Joanna.
Fantastic.
Mark Sauer from Cincinnati, Ohio.
All right,
our regulars, Gary and Rosalind O'Reilly from Marietta, California.
We regard you.
We got the fairy godmother in the house.
Ms. Jen Filson.
We got the shaman of the community.
Nadeem Shah.
Trademark, good morning, good afternoon from the Pacific Northwest. We got Venny Valsamakis.
Venny's amazing.
Do we not give Venny a nickname?
I feel like we were working towards one. I don't remember though. Venny, can you help us out? We need a nickname for
Venny,
you.
I apologize. I failed you. Here on the beach, Kate.
Christopher Lee.
From Fernandina Beach. We got Leo Faraganan.
Dun, 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 dun.
Faraganan.
Dun, dun, dun,
From
dun.
the Bay Area. Let's rock. Leo, good to have you back, buddy.
Absolutely.
We miss you around
We
here,
do.
bro. We got Saran with a plan.
The Rand with a plan.
From Jersey. We got Iab Eskander.
All right, Yob.
Good to have
nice
you.
to have you.
Belinda Baldwin is back from Dallas.
There we go, Belinda. Nice to see you.
Mark all the Irish in the house today.
Brian.
Kevin O'Brien, welcome to the show.
Great to see you.
We got the ringmaster,
Drew Barnell.
Drew Barnhill. Who else we got? We got LinkedIn Lowry in the
All
house.
right, Ed Lowry. Nice to see you,
He
buddy.
said, "Nice job on the run. The bridge is a lot of fun. By next year, man, he will let me run it again." He's talking about the Gate River Run that we
That's right,
did.
buddy. How about that,
How
huh?
about that 15K on almost 10 miles
We
through the urban core?
And the last one is the Green Monster.
The Green
and we
Monster.
scaled the Green Monster.
Yeah, it was a big one. 20,000 people down.
Oh, man. I was telling people about this. You know, I've run this 3 times. This is our second time running it together?
This is my first time running it.
This is your first time?
Yeah.
Oh, all right.
We've signed up like 3 times, but
That's
you've
true.
overran it twice.
That's true. I can tell you this year was so special too. It had been 3 years since I ran it, and just being downtown, we got to start and stop the gate. What we were talking about is the Gate River Run, which is done every year for the last 49 years in downtown Jacksonville. But this year they changed the path because there's so much construction going on, and we started and we stopped right on Bay Street, right on the water. The Four Seasons, which is being built right now, our first 5-star hotel is right there as we're passing the finish line. I mean, it was really fun. I think the amount of civic pride this year was notable. It was even higher than I ever remember between the amount of runners, the path, all of the places to go and have either water or beer along the path for the runners. Everybody was just outside in their yards, just cheering people on. It was a lot of fun.
It was really cool. It was really, really cool. Who else we got? I lost track. Oh, Jay Curb is
all
in
right,
the house.
Jay.
Jay, good to have you. We got Todd Drennan from Pittsburgh.
My fellow Steeler fans. Steelers just locked up a number 2 wide receiver, by the way.
Did they?
Yeah. Michael Pittman.
Oh, that's not bad. Deep threat.
Yeah.
Yeah.
We'll
good
take
stuff. Good stuff. Is Todd the new name? Do you know Todd?
Well, Todd, he came to Summit.
Oh,
he and his son came to Summit, and I got to know them very well, and we talked a little Steelers, so it's really nice to have you, Todd.
Good to have you on the show. We got Il Maestro's in the house.
John Williams
from Long Island, New York, world famous composer. Who else we got down here?
Miss Danny Davies.
I missed the mystery man. The mystery man.
Man, it's so nice to see you, mystery man. We appreciate you, and thank you for all your service, man.
Danny Davis, I failed you once again. Who else we got in here? Alan Wolf from Allen in Cincinnati.
All right.
Alan,
new name.
Welcome to the show.
New name. Welcome.
The Wolfman.
The Wolfman. I love it.
All right, Alan. Justine Herrera's in the house.
All right, my ride-along partner.
California, good to have you. And I think we're starting.
Tony D.
Tony D.
Goodness, man. What are you, a rookie over here?
This is a rookie move by me. Tony D. Good to have you, buddy.
Great to have you, Tony.
Sergio Prieto.
Go Gators.
Go Gators. Sergio.
There we go, my buddy.
Undercover Puerto Rican is what I call him now.
There you go.
Yeah, I did not see that coming. My man is super Puerto Rican.
There you go.
Yeah.
He's a great dude.
Sergio, good to have you. Good to get to know you and your wife, buddy. All right. So back to the report. Let's share this report here in the chat so that everybody can see it. The ULI Emerging Trends in Real Estate report is something that we track closely because the ULI Urban Land Institute is kind of like this. Oh man, I'm all the way down here. Let me scroll all the way to the top.
All 139 pages. This is going to be a great viewing experience.
Oh no, I can just go.
You could just do that.
Yeah. Look at that. There you go. There you go. Sponsored by PricewaterhouseCoopers and the Urban Land Institute. United States and Canada is an all-encompassing report. How do you describe kind of like the significance of this report, Justine?
I think this is a very extensive, a very researched report. When it comes out, people who know read this report, and people who make decisions really read this report. It's something that came on our radar, I would say probably about 5 years ago we started to read it. We're a member of ULI as well. But I really started to pay attention to it about 5 years ago because it started to outline trends that I think we were already seeing, but then it got laser focused on some trends that really came to the forefront in the years since I read the report. One of those trends where it identified supernova cities. And so last year we shared the report, and what do you know, Jacksonville is one of those supernova cities that they outlined. So it's a really, really good report, and something that those who are in the know.
If you know, you know.
If you know, you know.
So that being said, we read through this thing also with our friend Chatjapata from France. We analyzed it. We messed around with it a little bit, and we found kind of like 5 key trends that they talk about throughout the report that I think are really, really good for our community to understand. I'm going to basically break out what the trend is, give the bull and bear case inside the report for what they're talking about, and GC are going to discuss it. So first trend, this may sound familiar, is this theme of the Great Reset. There's a structural repricing of real estate. The bull case for this in the report is that the healthy pricing after the cheap capital era, real estate industry is adjusting to a new cost of capital environment, not collapsing. Transaction activity is returning after the interest rate shock of 2022, 2024, what we call high interest rates for longer, right? Limited new development over the last 2 years could create future supply shortages supporting rents and values. And buying opportunities are considered the strongest in 2 decades, according to the report's buy sentiment score. Implication there for the bull part of it is that long-term investors who understand the cycle may acquire assets at better yields than during the 2015 to 2021 cheap money era. That's a big proclamation that's being made there. The downside there, the bear case, is that maybe values need another leg down, right? Like that higher for longer interest rates could prevent the cap rate compression. A pricing gap still could remain between buyers and sellers, and as loans mature, distress and forced sales could still increase, especially in commercial real estate. And the investor takeaway there is we may still be in the middle of repricing, not at the end. So I said a lot there, GC. The Great Reset. I'll let you react first before I go into my thoughts.
Well, when I first read the title of this being the Great Reset, I was like, oh no, did ULA go down the path of like a sensational headline here? Because I haven't felt that there was like a great reset. As I started to read more about the points that they're making, I could understand a little bit more. But Great Reset to me sounded a little bit sensational, to be quite honest. To me, this just rings of what we talked about in our summit keynote and what we talk about often on this show. It's the fact that like this asset class just works. It can be viewed as somewhat boring. I love the fact of the boring nature of this asset class, but right now there is a better boring nature to it. And better boring to me means that yields are better today than they were a year ago. So that makes sense. The Great Reset that they're talking about is the resetting of how we achieve these returns on investment through single family rental properties. And, for the last, most of the last 10 years, there's been this age of easy money. And when you are in an age of easy money, it gets a lot easier to be able to produce returns on investment. And so resetting from that makes a lot of sense for me. Resetting overall for real estate seems a little bit too sensational. And that's really where my head went when I first read the report. So I would just say, listen, we're back to basics. This asset class has worked for decades and decades. It's number one about the yield to make sure that it pays for itself every single month. And then on top of that, choosing the right market and will help you, achieve those great returns in home price appreciation. But it's less financial engineering, it's less age of easy money, it's less lower interest rates that's going to get you there, I guess is my take.
Yeah, I'm a big believer in context shifts, Greg, and kind of like I look at the world through like the lens of like our context shifting, because when a context shifts, a new opportunity emerges, right? So I see this less as the word reset bothers me less. Like you said, I think our keynote was very much about that. It's like, hey, let's reanalyze what the world looks like today. So much has changed. What is the new context, right? So I can get with that. I like the summarization of it as, the last context was the age of easy money. It didn't mean that everybody that got into real estate made money, right? Just like every entrepreneur that started a business didn't make money in the last 10 years. Right. But boy, did a lot of like bad entrepreneurs make money.
Yes. Yeah.
Like over the last 10 years.
Yeah.
I know a lot of, less sophisticated real estate investors made money over the last 10 years. Like the going was good.
Yeah.
We are now in a new context, which is you better come at this thing with a little bit more discipline, with more operational chops.
Right.
Like it's not going to cure all the same mistakes that it was curing before. Right. Like you have to be very tactical about this.
Right.
In this era.
But I keep going back to basic. That's the way that real estate has performed, especially in single family rental properties for the 2 decades that I've been investing. And for the 2 decades before we have really good data, going back 40, 50 years, that's when we started to have really good data, and that the operational part of it was the key. And it is the key again. the age of easy money allowed for some operational deficiencies to be covered up because of the low interest rates and the subsequent high equity gains. But it's back to basics now. It's interesting because I go back to when I started in 2006, and I remember feeling like my business partners and in 2006, we were a couple of 20-somethings. We had no experience. We were just out there having fun, and we had some success. We had some articles written about us and all of this, and we thought we were really good. We were not good in 2006. It took 2008, 9, 10 to realize that we weren't good, and that forced us to refine and become great at it. And then, of course, that led to much better operations for us and for others who stayed in the game. Yeah. And then eventually the cycle, continued, and then it became the age of easy money again. Well, this is not anywhere like the Great Recession, but you can see a sort of a similarity where, if you were investing in 2018 to, 2022 or 2020, around there, you could think to yourself that you're really good, but you really weren't. Now to be able to have this asset class perform, it has to be operator first. It has to be operations first. And that's really where the value comes from.
It reminds me of another thing from the and it's this idea of battle-hardened team. And as a consumer, right, as an investor, if I'm looking at this, I think from 2012, like call the age of easy money, 2014 to 2022, right? If I wanted to invest with someone in 2020, it was hard to kind of like go back and be like, hey, let me talk to clients and show me how you got them through 2008, because maybe they weren't in the game in 2008. I feel like today, since this is like the focus on operational excellence, if you are somebody that's investing with whether it's a turnkey provider or another form of investment vehicle where you're taking the passive route, the ability to say, hey, let me talk to the people that were putting money with you over the last 5 years and see how happy they've been. To me, that feels like that almost feels like an advantage as an investor these days, because now anybody that shows up, they just started or they don't have references over the last recent history. Now you can really see the receipts of are they the good operator that they say they are, or was this just happenstance of easy money because it hasn't been as easy?
Exactly.
Yeah,
exactly.
So we're going to go into these 5 different points. One of the points that within this point is saying that this may be the best era of real estate investing. Like this could be better than 2014 real estate investing era. So I think right now we do the bonus point and go back in that statement because it said it in that reading. And it basically listed 5 different reasons why they say that the next 10 years could be even better than the previous 15 years. I'm going to go point by point on that, GC. One is the return of yield. Income really matters again. This word yield is not something that we've used a lot. What is yield?
Just cash flow divided by the amount of money that your initial investment.
Got it. Got it. Okay, cool. Why this creates opportunity? Because from roughly 2012 to 2021, investors made money primarily through appreciation driven by falling interest rates. So cap rates compressed dramatically when that happened. Cheap debt pushed prices higher. Rental income was often secondary to appreciation. And now the opposite is happening. High rates mean assets must produce real income to justify their value. And rents are higher and prices have corrected. So that means that buying yield is possible again right now because of the last couple of years, right? And then the skeptical view is saying if rates remain elevated, cap rates may not compress as much, limiting appreciation. So investors may earn returns primarily through cash flow and amortization, which historically drove a lot of real estate wealth creation. That's a lot of words, GC.
Yeah.
When I pick all that out, I can't help but think, wait a minute, is the age of, the Pac-Man over? Like is home price appreciation no longer going to be driving the returns? Is that what this is saying? Can you break that down for me?
Yeah, let's start with the counterpoint of the skeptical view.
Yeah.
First, because I don't agree with the skeptical viewpoint there, because the Pac-Man principle is based not just on the last 3 years or 5 years of much higher home price appreciation. The Pac-Man principle is based on us having average home price appreciation and you holding onto this asset for 10 to 20 years. So we're not banking on the fact that, for some years we had 10 to 20% home price appreciation to make the Pac-Man principle work. So if all we have is boring, consistent home price appreciation that averages about 4.5%, 5% a year in Jacksonville is what it averages, and the Pac-Man principle still plays out, and you'll still see between 60 to 80% home price appreciation. And that's why clients who have
60 to 80% of your returns coming from home price appreciation.
Thank you. 60% of your total wealth pie will be because of home price appreciation. That's just the way the numbers play out.
Yeah.
So if interest rates do stay high, that doesn't mean that we're not still going to see home price appreciation. Home price appreciation is largely pegged to inflation. It's very similar to inflation because this is a hard asset. So even if interest rates stay elevated more than we all want, to me, that doesn't break down the Pac-Man principle. Your Pac-Man principle today is much higher. Your percentage of home price appreciation of your total wealth pie is much higher just because you started out fast because you bought at a great time and it went up. But what I always told you from the very beginning when you were buying is, listen, you're not always going to have this home price appreciation. Things are going to level out. And after we look back, after you hold these things for 20 years, you're going to have somewhere around an average of 4.8% home price appreciation every year. And that's the way that's playing out right now.
Yeah.
So long story short, the skeptical viewpoint here, I don't agree with. Even if you have higher interest rates, we will see the Pac-Man principle play out and home price appreciation will still be a significant driver of your overall wealth.
And that makes sense. So this is basically saying that I feel like you've said this a lot on the show, right? Like you're like, often people will offer rental properties, like other turnkey providers will offer rental properties and they'll put 8, 9, 10%,
oh my gosh,
expected home price appreciation because they're using the average of like the last 5 years.
Right.
And that has this like huge spike from 2020 to 2022.
Right.
And that's not really the returns that you're going to get over time, right? So it's like, if you are still zooming out and looking at it over 40 years and normalizing the market to that, that's where the Pac-Man principle comes from. Tell me more about this yield principle, right? So like when I hear this idea of like income mattering again, I think of what we were talking about right now of builder incentives, putting cash in your pocket right now, vacancy doing really well. How do I think through this idea of yield mattering?
Yield matters now. I mean, if you go back to the show that we have done for years and years and years, you've seen my language regarding cash flow change, right? Some things stay the same, meaning like, listen, we need to make sure that these assets pay for themselves. But a lot of times we were talking about how, listen, break-even cash flow is okay, which is the truth. In owning single-family rental properties, break-even cash flow is okay, making sure that it can pay for itself. You're planning for a rainy day. And after you've planned for that rainy day, making sure that it can pay for itself. Break even, it's okay. But now when we're talking about cash flow or yield, we're talking about earning a couple $100 a month in positive cash flow. It's another way of saying that you get more yield today than you could have had a year ago, 2 years ago, 3 years ago. And so while it's not life-changing, right? It's not saying that a couple $100 a month is going to change your life, but that's $2,000, $3,000 a year of yield. And that's yield that we feel. That's return that we feel because it's in your bank account. And really what it does is it helps you buffer for a rainy day. Not only is the property paying for itself every single month, but now you have excess cash flow or excess yield. So I think it is really important because to me, it just helps. It's not going to get you rich. It's not going to be the thing that's going to drive you to your financial outcome. It's going to mitigate the downside. It's going to make this even more enjoyable. Which the biggest risk in this whole asset class is if you just buy and sell. Like if you just buy, you have a great operator, you just buy and you hold for a full market cycle, you're going to be fine. And so yield, excess cash flow that we have today because of the environment that we're in is a great thing. And it's possible today and it really wasn't possible a year or two ago.
So that is reason one why this might be the next great era. The reason number two is that supply shortage is getting worse. This now starts to sound really, really familiar, right? So huge dynamic is this like lack of construction, developers slowing down dramatically after sales rates spiked. Key drivers were the high construction costs, high financing costs, difficulty in permitting, labor shortages. This means less housing supply entering the market over the next several years. And when you compare that to population continuing to grow, household formation staying even, immigration still happening, and millennial renters still, like being a big part of the population, less supply plus steady demand equals strong rental growth potential. The skeptical piece of that is that some markets temporarily had some oversupply, and but new construction fell sharply. The experts expect new construction to fall sharply by 2027, creating the shortages again. I feel like that is a familiar trend that we feel like. It's like anytime that we are having like a little dent in the supply piece, everything turns off again, and it takes a while to restart. GC. So
Yeah.
what do you think about this one? The idea of like supply shortage getting worse. Let me guess. You agree?
I agree. I think we should drill in a little bit specifically
Yeah.
here to talk about the difference between single family and multifamily because it's a little bit different. If you go back 2, 3 years ago, we were undersupplied for both. Today, we are still undersupplied for single family housing. But today, in some markets, Jacksonville being one of them, we are oversupplied for multifamily housing.
Yeah.
And we are absorbing that multifamily supply. If you look at prices and rent price growth for single family in Jacksonville versus multifamily, you'll see different stories. Last year, rent prices for multifamily fell about 2%, whereas rent prices for single family were slightly positive. I think it was about 0.8% positive.
Yep.
And the reason is because of supply and demand. So we do need to bifurcate that a little bit. Now, we are oversupplied temporarily for apartments because in this age of easy money and in the Sunbelt markets like Jacksonville, all of this money and all of these developers came together and they built a ton of multifamily units, which can happen in multifamily.
Yeah.
Much harder for that to happen in single family. So temporarily oversupplied. The absorption is happening on the multifamily sector. The worst pain of that has been felt over the last couple of years from the multifamily side, but us here in the single family side are largely insulated from that. We started undersupplied on single family. We are still undersupplied on single family.
Yep.
And the reason why we haven't taken more of a dent in solving the supply issue is because builders are having a hard time selling their homes right now.
Yep.
Because of the higher interest rate environment. So they're not going to go out there and just start to overbuild. So what this does is this really insulates us and mitigates our risk because at the end of the day, the asset class that we are investing in is in short supply. And when something's in short supply, you want to own it.
Yeah.
And that's really where we are for single family rents. And if we combine this point with the previous point about how this could be the best 10 years in terms of yield, you start to see that when housing affordability creates challenges, people can't buy because homes are so expensive. They need a roof over their head. That renter demand is going to grow. And so the data that I see and that comes from John Burns, we start to look at what they expect for rent price growth for single family and for multifamily, and they see rent price growth going up year over year over year, which would create better yields, or for what we really say in our community, better cash flows in the futures.
Okay. Yeah. I had a feeling that that would be perfectly aligned with the show, right?
Yeah.
This is one that is kind of counterintuitive to us as well, based on what we're talking about on the show. Another reason why they believe that this is one of the best time, this might be the best time in 10 years, is that institutional capital is still flooding into housing. Large institutions continue to increase allocations into housing, like pension funds, sovereign wealth funds, insurance companies, because housing is viewed as inflation resistant, kind of what you're saying, essential, stable income. Single family rentals in particular have seen a massive institutional interest. And this creates opportunity because institutions validate the asset class and bring liquidity, price support, long-term demand for housing assets. The skeptical view is that institutional investors can also drive up prices and compete with smaller buyers, but most institutional capital targets large portfolios, not scattered individual homes. GC, what do you think of that?
Yeah, I think this if we want to think like the big boys and girls think,
Yeah.
and they're controlling billions and billions and billions of dollars, they're looking for assets that are consistent, that are inflation resistant, that the basic value premise makes sense. And if you start to think about those characteristics, single family rental properties make a whole lot of sense. Check, check, check. There aren't a whole lot of assets right now that are so insulated. In the world. I mean, things are chaotic in this world right now. So you can understand why money is continuing to come into these types of institutional players, and then that money from the institutions gets put into single family housing. The couple of things that they mentioned there, the competing with the smaller buyers. Right, there has been some headlines, and we're going to talk a little bit more about this in the market outlook coming up in a couple of weeks. There's a little bit more clarity on how they're defining institutions with Trump's executive order, so I can give you guys a little bit more clarity. But regardless of the pressure to keep institutions from competing with single-family regular buyers, institutions are not buying a whole lot more at the moment. Institutions are buying less than 1% of all single family rental properties in the country right now. So I really don't agree that there is, and this was the counterpoint or the skeptical view, but the numbers just don't play out that there's a big competition happening between regular mom and pop investors, institutions. So, there's some pros and some cons. Could institutions, all of a sudden decide to sell all of their assets and depress the market? People have been fearful of that for a long time. But you go back to why these institutions go into this asset class in the beginning: stable, inflation resistant, something where the value premise makes sense, and they undersupplied, right? Like the investment thesis is playing out for them. So, and they were buying to hold. That's what their investors are planning to do. So, all in all, yes, I think when institutions are playing in this space, we should look at that and say, you know what? They know something. We should think about what they know, and we should do more of it.
Yeah, it's kind of what it's talking about, right? It provides price support, long-term demand for housing assets and liquidity. If you're someone that has it. I found it really, really interesting that it talked about, inside the report, it wasn't just talking about institutions, going out there and like buying single homes here and there. It talked about, portfolios kind of like trading hands. And then it also talked about them just getting into the game in different ways. Like they're partnering with builders in order to build. They're not necessarily like, going out there and buying single family properties, but they're like bringing to market single family properties in an undersupplied asset, right? Like to me, what I see in this like institutions getting in is just like, all right, cool. If we can't go out there and buy it this one way because we're going to create either a PR crisis or whatever is happening, we're going to find other ways to get our money in because we believe in the asset class so much. And, quite frankly, if I'm a big fund manager and I have all this capital and I'm thinking, God, we're in this middle of all this chaos and like, where am I going to park this money? Single family housing
kind of makes workforce housing, single family. I mean, it kind of makes sense,
if you
right?
want to be a good steward of assets.
They're looking for something boring, right? They need a little more boring in their lives, right? That's why they're coming here. Yeah, absolutely.
The fourth point of why they're saying that this might be a really, really great time to invest in real estate. This is less about single family homes, but it's talking about distressed opportunities emerging. This idea that commercial loans came due between 2019 and 2020 from 2022 must refinance at much higher interest rates, create stress on those operators, and the estimate suggests hundreds of billions in commercial real estate loans need refinancing in the next few years. And this means that some owners are going to sell those assets, are going to recapitalize, they're going to have to structure debt, and investors with liquidity may be able to acquire assets below replacement cost in that sector. The skeptical view says some of these distressed assets may remain contained if they just find extended loans and lenders to be there. But even if distress is gradual, liquidity events create buying opportunities for folks. So not necessarily for our space, but they're saying there's going to be opportunities in real estate.
It all comes down to the debt. Yeah. And that's one of the things I love about single family rental properties. Yeah. You buy it, the debt is fixed for 30 years. And that's such an asset, really, when you think about it. You don't have that in commercial loans or multifamily loans or commercial office buildings. Those have maturities that are many times 5 years or maybe 7 years down the road. So those are coming due, and do see that there are strong opportunities to buy distressed assets, specifically in the multifamily space. I see that. I'm sure there are in the commercial office space, but the one thing that I would say is that we have been talking about this cliff that was coming from commercial assets and the debt, the expiration date coming, the balloon dates coming, and the hundreds of billions of dollars. We've been talking about that for years. It makes sense to me on paper, but I'm just not seeing this cliff ever really, materializing. And to me, that just means that the banks are restructuring the debt with the owners so that everybody can kind of make it through this time until interest rates come down.
Yeah.
And I think that's largely happening as well.
Yeah. Once again, real estate is just one of these things where everybody kind of like plays together to make sure that it doesn't go too far down.
Well, when it's in everybody's best interest, that's what they do. I mean, like the lender, if they were to foreclose on it, then they have an asset there, and then they have to service it, and then it's not the best time for them to sell it as well. So I don't think everybody's doing it for altruistic, means, but I think everybody can kind of come to a marriage of convenience when it comes to restructuring the debt on the commercial side many times.
Makes sense. And then the fifth reason why they're saying that this may be the best period to buy in history is that demographics continue to favor housing for decades. The biggest driver may just be population dynamics. That is millennials, which is the largest generation by population, moving through their prime housing years. Gen Z is entering the workforce. Immigration is continuing. Household formation remains strong. So housing demand is going to stay structurally supported. And demand for housing is less cyclical than most asset classes. People always need a place to live. It goes back to this point of like critical need. Skeptical view is saying that the high housing costs could reduce household formation. That's like a big, I don't know where that goes from there, but counterpoint, reducing household formation could actually increase rental demand, especially in workforce housing.
Yeah, I mean, I agree. I think the tailwinds here of owning something that is not just in high demand today, but that seemingly will only see higher demand going forward makes a lot of sense. That's why we want to own that asset. And then we own it specifically in the most underserved section of housing as well, which is workforce housing. There is a missing middle. There is missing housing in the neighborhoods that we need it the most, and this is where affordability is the biggest challenge. And so we want to. It's a great asset class to be able to own, and something that not only works today from a supply and demand perspective, but hard to see how it doesn't work for supply and demand to be in your favor into the future.
Yeah, I think of things that take a long time to shift, and that's population behavior. Right? Like if population is basically saying, hey, we've got all these millennials, they're like they're not going anywhere, right? Like we're most of us are going to stay alive for the next 20 years, right? Like statistically speaking, all need housing. Gen Z is moving into the workforce, right? They're going to need housing, whether or not household formation goes down, right? Like there's still behavior that will continue to drive this thing, right? Like over the next 20, 25 years, this glut of millennials and Gen Zs will all need housing, whether they get married or they just need roommates to afford it, or or they're having conventional family formation, or they're having kids out of wedlock because maybe culture changes somewhat. Like I just can't imagine human nature to shift like off a cliff the way that other things can happen of like, we could stop consuming something way faster than we stop being human and needing housing and all these different things, right? So that's like the long tail thing that I find is just like, yeah, okay, you can really like set a clock to this.
Yeah. And I love assets that like no matter which way it shakes out, you're probably going to win. That's why I say if you just buy and you hold, you win in rental property. It's been proven, right? If the rentership society sort of takes over for Gen Z and the millennials, right? Well, then you're going to see significant rent demand. And that means that your yield is going to go up, which is what this report is talking about. And you win there, right? Well, let's just say that something shifts and everybody wants to go buy houses again.
Yeah.
And the dream of home ownership is reinvigorated. And then we have 72% of home ownership in this country again. Well, you win again. You win because then prices would actually go up as well. And you'd probably still win on the rent side. So that's why this asset class is so beautiful. There's so many ways for you to win as long as you buy and hold.
Yeah. And that is, again, that's a summarization of like the main point of this whole thing and what it's talking about. This great reset, structural repricing of real estate is really them saying that this is a new era of real estate, right? Like the cheap money era is done. This is the smart money era of real estate, right?
I like that.
And it is essentially predicting that this that buying opportunities are going to be strongest over they've been in the last 2 decades for this, right? So that's kind of like one big takeaway from this thing. We've got a handful more.
We do.
Yeah, you want to jump into this? Second is interest rates and the fog over the market, right? So the report repeatedly describes the market as navigating fog. The bull case here is that capital markets are gradually improving. Rate reductions, like we were talking about beginning in 2025, have increased transaction activities already. Easier financing conditions are bringing sidelines investors back into the market. Liquidity from institutional capital and retirement accounts may increase over time. That implication means that demand could return really quickly once rates stabilize. The bear case is that 90% of survey respondents cited interest rates and cost of capital as their biggest concern, along with inflation, tariffs, labor shortages, and could keep these borrowing costs elevated. So, there's still this kind of like fog that's happening. We're like seeing like a better path.
Yeah.
But there's still fog, and people are still just kind of like walking around in it.
Yeah, I can get down with the fog
Yeah.
metaphor there. I think, people are looking at the fundamentals here and they're saying there's something here, right? Yields are improving. So people see that, but it's still hard for people to take action. And people are seeing, listen, I understand what happens, that interest rates are a little bit higher, but I understand what happens when interest rates come down like they have. Interest rates today are about 1% lower than they were 1 year ago. And we understand what happens after that happens. Mortgage application starts to rise, the number of mortgage applications start to rise, and as we get into the spring and summer seasons, we start to see much higher home sales data, which is on the horizon. So I think people start to understand elements of that, but it's still really hard for people to take action. And it's because there's so much noise or fog or whatnot. There's so much information that's going on into our brains every day when it comes to what's going on in the world. And how does that affect tariffs? And, we have labor reports that come out and it's a negative labor situation, but we also have inflationary things that come out, and we see that the cost of energy is going up, and we're like, I don't know, fog, brain fog, like how do I take action in a time like this? So I can feel that in our clients and our show, I can feel that in myself because it's a little bit hard to separate that noise. But I think this is a time to understand, to kind of separate the noise from the fundamentals and lean into the fundamentals. And if you lean into the fundamentals, you'll be okay.
To me, it comes back to this is people seeking certainty, right? Like with all this fog, all this type of stuff, it's like, what from a first principle standpoint do you know that you can bet on, right? Like I think the opportunistic, like, oh, I'm going to get in before rates go down, or like whatever's happening is one thing, but at the end of the day, it's like you still need a plan for your retirement. You still need to like put your capital places in the bank as cash. Like that's on you. Like that's the loser. So you're looking for something where it's not a loser, where it's a likely winner, where it has the highest kind of like floor that you can find. And to me, the only way that you find that is a structurally, fundamentally strong investment that looks good across any time you look at it, and a really, really great operator that has delivered over and over again in different circumstances. That is the only certainty that's out there today. And that to me is like the only way you get through fog, by like holding on to something and knowing what you're
100%.
You know what I mean?
100%. Right. The interest rate and the future increase in demand that comes from it, that should not be the reason that you make this decision. It should be operator. It should be experience. It should be your ability to buy and hold and see how this asset is going to work for 10 years, 20 years in the future. And then you can sprinkle on some really good things like, well, when interest rates go down, what's going to happen? Or the downtown Jacksonville conversation. That's the icing on the cake.
Yeah, got it. The next big thing that we see a lot in this report, housing affordability still being a dominant macro trend. So housing affordability and availability were cited over half of industry leaders as top social issue affecting real estate. The bull case, you're going to love this. Workforce housing is the opportunity. Persistent housing shortages support long-term demand for rental housing. Single-family rentals and workforce housing provide essential supply. Demographics, millennials forming households, continue to support housing demand. The implication is that providing affordable rental housing may be one of the most durable investment themes of the decade. The bear case here is policy risk, right? So like as this stuff continues to like be louder and louder and more in need, governments may respond to affordability pressures with rent control, zoning restrictions, tenant protections. Political pressures seems to be the one risk that could limit rent growth or increase regulatory costs.
Yeah, let's take the bull case.
Yeah.
I mean, it's what we've been preaching for, almost a little over half a decade now.
Yeah.
And you're kind of hearing it from one of the most respected reports. Workforce housing is the place to be. It's the place to make the best returns. It's also the place to help the most for this country when we were looking at affordability as being a challenge.
Sure.
Building more units in workforce housing is helping our neighborhood. So it checks, both sides of the brain there for me. So you're hearing it from ULI. You've been hearing it here on the Not Your Average Investor Show. Workforce housing is the place to be. The bear case, talking about policy risk, that's a thing, man. That's a thing. Policy risk is out there. The good thing is that I don't know if this is a good thing, but policy risk is out there no matter which asset you're thinking about investing in.
Sure.
With what has just recently happened in the world and our involvement in the war, and thinking about what happens here at home, if I just take the people element out of it, obviously that's where our thoughts and our hearts are. But if I just put my investor hat on and I'm just thinking about economically what happens here, well, there's a lot of inflationary pressures that happen. The cost of energy is skyrocketing now, and then that is a big driver of inflation across our entire economy. And that does things to different asset classes. If I start to think about workforce housing, single family rentals, are we affected by policy risk? Absolutely. But you could make an argument that we're a lot more insulated versus some other types of asset classes that are going to feel the brunt, especially of higher energy costs. So the other thing to keep in mind is, if there are policy risks when it comes to single family housing, it is not a blanket all across the country. Like, for example, rent control gets thrown out a lot. Rent control, if it does happen, happens in other states. It's not on the table here in Florida. I haven't heard anything of it. I haven't heard anything of it in a very, very long time, and definitely not here in Jacksonville. But it does happen in other parts of the country. There is an ability, if you do find policy risk adversely affecting your single family rental property investment, that you can do a 1031 exchange and go from one market to another advantaged market like Jacksonville. And the last thing I'll add here is, policy can change in your favor too as a single family rental property owner. There is a lot of chatter right now about eliminating or significantly reducing property taxes in the state of Florida. That would be a policy change that would have the word is out as far as if it's a good thing or not. But if you're an owner of real estate, that's going to mean so much more housing demand, and that's going to mean prices going up for your assets. So specifically, if you're just putting the lens on of if you would benefit from that as an owner of single family rental properties, you absolutely would. And that could also be a policy thing that could help return on investment. So policy risk is out there, but you know what? So many ways that you're insulated by being in the right asset class, which is workforce housing.
Yeah, it's kind of like what I've been telling you, man. Like it's hard to find any business story these days that doesn't have like a governmental angle to it.
Right.
So like the idea that like policy risk is out there, policy seems to be like front and center in executive orders, in headlines,
Hmm.
in, political warfare, whatever we're doing out here there's a lot of policy going on in the world flying around. Um, I do like this idea that, for me, what I think of is tried and true. It's worked for a really, 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 really long time, right? Like the idea of just like, hey, the fireman needs a place to live and and support their family, right? Like and raise their kids. That will always happen. This whole like macro trends of the population driving these things, this being the dominant trend based on everything that we've talked about, doesn't surprise me one bit.
There you go.
Okay, so number four, capital is shifting towards, this is kind of related, towards resilient asset classes, right? So the report talks that investors are rewriting their playbook, shifting capital towards sectors with durable demand. So here are the sectors that they say have durable demand that are operationally resilient, and I think they all make sense to us. Single family rentals, of course, data centers, senior housing, self-storage, and medical office. These sectors benefit from structural, demographic, and technological trends. Income producing real estate with essential demand is becoming more attractive. And the bear case here, the asset selection risk is increasing. Performance gaps between high quality assets and weaker properties are widening. Investors must now analyze specific submarkets and property operations, not just asset classes. This is back to saying the era of buy anything and ride the cap compression rate is over.
Yeah, I think both the bull case and the bear case are absolutely real
Yeah.
from my vantage point.
Yeah.
And I think money does want to move into more resilient asset classes and a resilient playbook, or what I call a boring playbook.
Yep.
We need a little bit more boring in our life. We just need a little something that's just going to work, and it's not dependent on this or that or the other thing to work. It's just been working for decades, like you just mentioned, and
Yep.
single family rental properties fit that mold. The other ones, some of them are a little bit more, um, I guess like opportunistic for this moment where we are right now, and maybe haven't been validated nearly as long as single family rentals. I just think of data centers, right? I mean, there's a huge demand for data centers right now.
Yeah.
I don't see that going away anytime soon, but that's a little bit newer to the game. Senior housing makes a ton of sense to me,
Obviously.
right?
Yep.
Aging population, of course. Self-storage is a little bit unique. We kind of looked into that a little bit, and
Yeah,
just
that one was interesting to me. That one's like doesn't make a lot of sense, but as far as like I see self-storage as more of like a luxury.
mhm.
But again, if what we looked into was that if um housing is becoming less, like less affordable, people are going to be living in smaller places. We're not talking about, people that are already living in workforce housing having self-storage. We're talking about people that are in like the higher kind of like social demographic luxury housing, moving into condos, moving their stuff into
Yeah,
self-storage.
I think the economics of it is,
Yeah.
it's not saying that people are just going to go out and buy a ton of stuff and then just go and have an extra expense and go store it in
Mhm.
storage, and that's not the demand that they're talking about. They're talking about a successful person who has the opportunity to spend less on housing or to stay in their existing home and basically downsize. And if they do that, then the cost that they save, where they don't have to spend it on new housing or additional housing, they can throw a percentage of that into a storage unit and stay in the same place,
Yeah.
is kind of
Yeah.
the economics of it.
Yeah. But yeah, makes sense. Like we talk, like it's like AutoZone stock, right? Like
Hmm.
like it's just one of those things where, like there is more resilient things inside of real estate, and you're looking for those safe landing spots
Hmm.
that do well. No, like what I'm really hearing here is macro trends,
Hmm.
right? Like is population things, right?
Hmm.
Like the single family rentals, senior housing, medical office building. Those are major, major macro trends that aren't going to shift anywhere. Data centers, I mean, it is newer, but it does feel like, hey man,
Makes a
we're
lot of
the
sense.
genie's out of the bottle. We're not
Yeah.
like going back to needing
Right.
less like demand on this type of stuff. So
Right.
really, really interesting to think about it in other asset classes now. And then the last one is that the new playbook is operations over financial engineering. Historically, many investors created returns through falling interest rates, cap rate compression, and leverage, and that dynamic is changing to the bull case of better operators winning. Future value creation will increasingly come from rent growth, operational efficiency, cost management, and asset level strategy. which really benefits, being with the best operator. The bear case is that passive investors may struggle. Investors who rely primarily on appreciation, cheap leverage, passive syndications may find returns harder to achieve in this environment. And the takeaway here is real estate is really becoming more of an operational business again. What do you think about that? Got some words in there that hit.
Yeah, I mean, it comes back to our order of operations to be successful in real estate and single family rental properties. Number one is team.
Yeah.
You find the right team, then you go to market, which is number two. You find out the markets that the team is operating in, and then you start to do due diligence there. And then if you do number one, which is the team, and number two, the market the right way, then the third choice, or the third operation of the property is enjoyable and easy. So that's what I hear, and that's what I see when we go through this. Better operators largely have always won, but if you were a less good operator, you could still win.
Mm-hmm.
Now, better operators win big time, and the reality is that there's not a lot of really great operators out there.
Yeah.
Both in the single family space and in the multifamily space, and in other asset classes. I mean, I know of a lot of operators that are really, really struggling on the multifamily side. It is really hard if somebody invested in a syndication over the last few years to be doing okay. And that's not to say that they're not great operators, but there's just a lot more of debt risk and time risk and all of that when you're in something compared to single family.
Yeah.
Single family, you can find a great operator. The debt is so much to your advantage. Yeah. You don't have to get it right this year or next year or the next 3 years in order to win in this thing. And that's why it's resilient and boring and it just works. So I agree with everything that last point said. Better operators win, and you have less obstacles to being a great operator in the single family space.
Well said, man. Like the theme here all throughout in all of these, like when they talk about it, it's like it's no more financial engineering. It's just like, man, when debt isn't as cheap as it was before, there's just less opportunities for financial engineering.
Mm-hmm.
So you can't hide behind that piece,
Mm-hmm.
right? Like it's really going to come down to fundamentals. Can you operate it? Can you deliver on what you say you're going to do, and continue to do that thing? Right? So it's like, it's exactly what you said. It's the order of operations that we've been preaching here for the last 5 years.
Mm-hmm.
And based on the outtake, the main message here being like that the last decade rewarded almost anybody that did this stuff. This next decade would really reward the people that buy the right assets with the right strategy and operate them really, really well. Is kind of like the takeaway here.
Yeah, I think over the last decade, there were still ways for people to lose. So like I go back to like times when, you really couldn't lose in single family rental properties, right? If you bought a property, yeah, 2000, really from 2001 to 2006 was hard for you to lose. And then, from 2020 to 2023, right? Like,
Yeah.
I mean, really hard for you to lose if you owned a rental property there, and still if you still own it today, because there was just so much home price appreciation. When it goes to the last decade, it rewarded almost anybody who bought it. I don't really feel like that is. I think you need to put some bumper lanes on that. There were still a lot of people that made poor decisions, poor operations, didn't win in single family rental property. So I would go with a smaller section of time, and I would go specific markets there. But the reality is that it's just different today. You have to be with the right operator today to make sure that this is going to be something that is going to produce for you so that you can stay in the game long enough. And then you really need to know the market that you're operating in to make sure that you can set yourself up for growth. Not every market is going to grow like every market grew, for the last 5 years. So know your operator, know your market so well. And one thing we didn't really talk about was the fact that there are things that are driving significant appreciation opportunities. It's just not interest rates.
Yeah.
Right. So we talk a lot about downtown Jacksonville. That's one hidden edge that you can have that's going to see higher home price and rent price and median income appreciation. But you got to know your operator and you got to know your market in order to figure those things out.
That was a media report, man.
Yeah.
I wasn't sure we're going to get that done in an hour, but we got it right in an hour. So, we poured through that thing. Hope we brought you some really, really good data and perspective there. Had a really good attendance today. Had about like 70 people here.
That's awesome.
So
Thank you,
yeah,
guys.
good. Way to show up. I think the message is clear, right? Like this is this reset that everybody's talking about. It's not really cycle related. It's like context related, right?
Mhm.
Like the cycle is the cycle. Real estate is still doing its thing. It's just that there is a shift from kind of like the easy money era into like the professional operator era,
Mhm.
and you're kind of like seeing it everywhere. I'm happy that we get to do this show. I get to, see this operation, the fact that you guys have been around, and like I feel like my money's safe because we're following the order of operations that we talk about: team, market, property.
There you go, buddy.
Right? Those are the fundamentals. Next week, I don't know if you were there for the summit, but we had this like impromptu Q&A at a house, and the JWB construction department really shone. People were asking about different maintenance things, right? Like I think as a rental property investor, you always worry about unforeseen maintenance expenses. And the JWB construction team was just there like, oh no, this is how we handle that. This is how we handle that. I think it's an under kind of like emphasized thing here. The fact that you guys have construction project management that allows you to mitigate for maintenance costs on the front end, allows you to decrease the cost of turns, and allows you to like keep those costs in check. So we're gonna have a construction teammate here next week.
We are. I'm really excited about it. A lot of this is so foundational to how we produce great returns for you, how we mitigate uh, not just maintenance costs, but vacancy costs too. And to have that level of professional expertise driving your investment for you is a real asset for you. And we get to shine a light on it next Tuesday. So super excited.
And then the week after that, market update, right?
That's
In
right.
2 weeks, save the date. If you're still listening on the podcast, you got to go register for this thing so that you want to see it. And from now till then, GC, any pieces